Your investment account, your retirement account is at risk, and I'll tell you why. You came here for the truth, so let me unveil that for you. Today, we're going to talk about what's happening inside the markets, inside the economy, how these two link together, what the central banks are actually doing right now, not speculating, what they are doing, the actions they are taking. All of this extremely important because it's going to have some fantastic moves here this year. So the first thing I want to show you is 1 million investment choices. People have an seemingly infinite amount of choice right now. And yet a lot of that choice not exactly beneficial for them. All right. So you look around and understand what people are getting themselves into. The vast majority are losing out. Losing out. It is very, very often that people, after taxes, after fees, after everything is considered, that they are in a worse position as time goes on. Who wins? It's the advisors. It's those companies that take the fees. It's those on the other end of those trades where people are losing to. Oh, yeah, I broke even, but you didn't factor in this or that or taxes or anything else. Oh, but I'm tax loss harvesting. Come on. Let's be honest with ourselves, okay? That's the deal. Let's look at the financial circumstances that we have today. A March cut is a shoo-in, says the market. And you're going to currently at a 75% probability, by the way. You look at that in 2 days, it's going to be a different number. Okay, it's constantly fluctuating. But in general, the market believes that the Federal Reserve is going to cut in March. I don't know. It's right now, as of today, it seems like that's a little bit early. If they would, by the way, the March cut is the announcement, and then the action would likely happen the following month in April. Regardless, when we see that, or there could be the quantitative tightening that begins in April, that's what they're saying. I don't know. Honestly, I really don't know at this point. It seems a little bit premature. However, they could then go out to the market and say, to the investors, to the public, and say, we want to do this, but we're just waiting. So they can kind of step with one foot. We'll see what happens at the coming meeting. I'll bring that to you. But everything is hinging on the Federal Reserve. These actions that they take, because it affects mortgages, it affects credit cards, it affects everybody. You know that. And now we've got a big concern. Fed rate cuts might overstimulate the economy. Of course. Financial conditions already accommodative at the current cash rate. So they're saying they're not restrictive right now. They are accommodative. This is what it is. I mean, you got to take financial conditions broadly. This doesn't mean just the Fed funds rate, but you got to take in like everything, widespread, everything into account. And this is kind of the situation that we've got to deal with right now. I don't know. Are they going to cut rates and then start to fuel inflation and then have to do it again? Or are they confident that inflation is over and done with? I want to insert something though. We've been talking about this 2% target. And if you remember, not long ago, I was talking about it a lot more frequently, but I believe that they could absolutely raise their target. Because when inflation gets down to that 3% level, it can become sticky. Many have said this before. 3% maybe is the new 2%. What do you think about that? Do you think that they would just simply raise their target? Look, we're talking about fake inflation. We're talking about the manipulated inflation. I get that. But understand where they are going right now. Okay? That seems like something that they could very well do. Or, as I've said before, maybe create like a window. They'll say between 2% and 3%. Instead of trying to precisely get at this 2% level, we have a sliding target, 2% to 3%. So they can achieve their goal without ever actually getting there. We'll see. Look at this. Financial conditions globally, while fairly recently, towards the end of the year last year, financial conditions were easing in the shorter term. Basically, since the beginning of the year, they've started to tighten a little bit. It's still way too early to tell, but that's what's happening at this time. So let's keep an eye on that because this affects everything. Financial conditions broadly, I mean, you'll see, look at, for instance, mortgage rates, right? Mortgage rates, while they are kind of indirectly tied to what the Fed would do, It's not directly, okay, because it's going to be based on the 10-year. So the 10-year is going to be the determining factor for the mortgage rate. But if the Federal Reserve continuously is increasing interest rates, then of course it would have an impact on mortgage rates. But now, even though that the Fed has kept their Fed funds rate at this level, mortgage rates have come down from 8% and now falling further. I believe it's over 1% drop at this time. Wall Street chiefs are finally calling the bottom of the deal-making drought that has plagued their earnings in the past 2 years. Executives at the biggest banks are expecting a pickup in the coming months, tied with the Fed's apparent pivot away from 2 years of interest rate hikes as they wrap up the worst year for investment banking revenue since 2012. So this is what they're saying. I'm pretty optimistic and so on. Of course, they always say that every single year. But we're going to look at that and see how it unfolds. I just wanted to make it clear that the businesses, corporations, the big boys that hire a lot of people, or at least employ a lot of people, they are hoping that 2024 is a different year than 2023, than 2022. And, we'll see what happens as a result of that. The stock market performed very well. The economy, on the other hand, was a mixed bag, that's for sure. The dollar here doing well over the last little while, and usually what we see is the inverse to the stock market, but not necessarily. So we've got to measure that in comparison to other things, dollar versus other peers, but it could be the result of other peers weakening considerably. It depends on what's going on with oil, how's that affecting one economy or another, and so on. So the dollar is always going to be that safe haven, but if they say, hey, we're going to cut rates, we're going to do this right now, then it does, in fact, weaken the dollar. If the dollar is weakened, it looks more attractive for exports. It looks more attractive for other countries to buy their debt, things like this. But it's balanced out with risk reward. So keep that in mind. All right. After a rocky couple of years for the Chinese economy, the country's stock market appears to be in free fall now. Authorities asking institutional investors not to sell their stocks in an attempt to stabilize share prices as foreigners are pulling out. The exact opposite was happening a while ago in the United States, where foreign investment was at the highest level ever. And so you see that. This is like a stimulus in a way. If a whole bunch of different people from all over the world are throwing money into your companies, that boosts your companies up. But what's happening here in China is the exact opposite. They're saying, I want out. Now, I told you two things about China. I said, hey, if they get these two things going, this is the biggest contrarian bet because everything had fallen so much that it would just skyrocket. What do we have? We have to see stimulus from the government that they're going to, hey, we're going to go out there, we're going to pump cash. The next thing is the tech companies, because they were hammering them hard. They're saying, hey, we're going to put extra regulations on you. Look at what's going on with Alibaba, Tencent, all these things. I said, if they start to ease up on those restrictions and make that known, make it very clear, and they start printing money, those two things, stock market's going to go wild. Stock market's going to go wild. And it kind of looked like they were going to do that for a little bit, but at this point, no, clearly not. And so you see the effect of this directly in the stock market. So it's exactly as I said. And in this case here, we just need to pay attention to the information that's in front of our eyes, and we're going to be able to determine what happens in the future. It's not a, Nostradamus over here, but these kind of things are obvious. Global debt refinancing costs have soared. Global bonds average yield minus coupon on outstanding debt in basis points. Just look at it. What all this means is that your government has to pay more for their debt that they've all added. So imagine 2020, they add all this debt and now they're going to pay the bill, but that bill is even higher, at the highest it's ever been when you factor in the amount of debt. And how are they going to pay that back? Well, I got a solution for them. What they can do is they can increase taxes on the middle class. You see, that would be the greatest way to do that because that would punish you the most. And what about your property taxes? You're probably not paying much in property taxes. So they can take those property taxes and they can add to them. And then they could add some additional sales taxes and maybe some corporate taxes and maybe some other things that are snuck in here or there, some carbon taxes, taxes on farmers, taxes on crops, taxes on imports, taxes on exports, taxes on breathing. Right. All of these things have happened in one place or another over the last little while. This is what we have to deal with right now. So what can we do about it, right? That's the question. Well, some people try to speculate their way out of it. I'm just showing you here the most valuable company. Well, it depends where you look over time. Most valuable company since 1995. Microsoft, by the way, had become the most valuable company just now. But you could see over the years, these things do change. Certainly. Very interesting to see how the developments over time and so on. But it is showing us that you've got to understand that nothing lasts forever. You can't get married to one thing because there's always going to be those dynamics, right? So that means you've got to constantly pay attention to what's happening with your investments, where your money is, and so on. If you are looking for some strategies, for some help, I have two things that I do. On Fridays, I do a 2-hour session, the Money GPS Finance Live, where I get into the depths of this. All of my group already know all this information that we talked about today. And what we can outline here is that, quite frankly, looking at the data, it looks like conditions get worse. So we need to do better. So during that session, of course, I explain things. They know things that happen 6 months, a year, 2 years out. Then on Sundays, what I consider to be more solutions, which is building an online business. Why? And beyond actually online business, but building a business and having this because you can take your money, your capital, and invest in something that is scalable. When you do an investment, when you do a stock investment, there's no scale there. You can't do that. You can't scale it. With a business, you could apply your capital in and it scales on the back of these platforms that I use. So I talk about that. All the links, link in the description there, the Money GPS Live. Okay, I hope that you will join me on those. We got a fantastic small group of people and I appreciate each and every one. I want to thank you for being here today. Hit that thumbs up button and I'll see you tomorrow. Take care.